all of this stuff is the bond market and gold's way of saying that you're trapped and you're going to have to jack up the rates on the back end for us to want to invest in it, which only puts greater strain on the economy. That's why we're trapped. It's I don't know what the right answer is. Then again, either you just let it all blow up or you paper it over until it blows up. It's a sad statement, but I don't know what the final outcome is or how you get out of this without massive production, increasing your GDP. And
Hmm.
we're a long ways away from that. We'd have to onshore all of our manufacturing,
Hmm.
train everyone how to do it, and become efficient in it. And that's going to take some time. So any way you look at it, there's some pain that we're going to have to go through in order to get through to the other side.
Not only have gold prices pushed to $2,800 an ounce, continuing their unstoppable rally, but they have also managed to hit new all-time highs even as bond yields remain relatively elevated. Momentum in the gold market comes as the yield on U.S. 10-year notes has pushed back above 4% and is currently trading near a 3-month high. Some analysts have said that the rise in U.S. bond yields is not surprising, as the economy and its labor market remain fairly resilient. A prominent figure in the financial services industry, AndySchectman, underscores the current market conditions, indicating that purchasing long-duration treasuries is unwise. He believes that the Fed's manipulation of interest rates will lead to higher inflation in the future, leading to a rising price of gold and the selling off in the bond market. The bond market tumbled so badly before October 2023 because of interest rates, inflation, and credit risks, especially in 2022. Despite the Federal Reserve's claims of controlling inflation, Andy mentions that traditional bonds are seen as unreliable due to rising counterparty risks. Current rates remain well above target, indicating a concession. Fundamentally, Andy states that the concept of holding debt as an asset is historically weak. Additionally, a Bank of America survey found that 71% of financial advisors allocate little to no investment in gold, despite growing interest from prominent investors like Paul Tudor Jones. Conclusive evidence shows that the U.S. national debt ballooned from $5 trillion to $35 trillion during this period, and gold prices rose by 10 times since 2000. That's a whopping gain of over 826% since the beginning of the century. But here's where things really start to get interesting. If history repeats itself, gold prices could reach $5,000 an ounce when U.S. debt hits the $70 trillion mark. Now, we present the clips of Andy Schectman's insights from his recent interview with Miles Franklin. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think there's a global need for a reliable store of value done again, and this is to facilitate trade and to safeguard excess capital. And I think the key is also without counterparty risk. I don't think the bonds can longer fully provide either. You see the Fed lower rates, as we've talked about. There's all this talk of signaling victory over inflation, but it's not. They were 60+% away from their target at 2%. What it is raising the white flag. What it is massaging and manipulating the numbers that comprise the CPI out of the Bureau of Labor Statistics. And whether it be about unemployment or about inflation, the numbers that come out of there are suspect, to say the least. And what we are seeing, really, as far as I'm concerned, is the market's way of saying, at this point, buying any duration treasury. This is me talking. Let me just say this: that anyone who would buy any duration treasury, 10-year or longer, to me is crazy. I think they're uninvestable. The Fed will lie about inflation. Inflation will only get higher from here, especially by lowering the front end. And the market understands this. Gold understands this. This is why gold is roaring. This is why the bond market is selling off and rates are going higher. And of course, you can talk about the weaponization of the treasury market, which only adds fuel to that fire. But this is something that I would expect to see continue. You cannot expect to lower rates, go back to an inflationary policy, especially with asset prices at all-time highs, and not expect there to be consequences on the back end of the curve, where holding at these rates for any duration when inflation will erode and eat away at the purchasing power is insanity. And so I think that's the market saying just that. The concept of holding debt as an asset, I don't think is something that has a massive historical footprint. When you over-lever the debt the way that we have, and this debt that's very interest rate sensitive, and then rates start to go higher and the economy starts to slow, the maintaining of debt becomes very big deal. And if the debt isn't able to be serviced, and this is the whole concept of credit default swaps, where if you're trading with another partner who you don't quite trust, you take out an insurance policy against them and their ability to pay. And the insurance company's like, well, that's big money. Let's do it. Let's do it. And then boom, it blows up. And then real quick, the whole thing starts to spin out of control. So it's a problem. It's a problem that has to be dealt with. And this debt problem can't really be paid back. So the ironic thing about it is that most of it is owed to the American people, Medicare, Medicaid, Social Security, the government and military pensions. And so much of the money that's gone into treasuries has, as the foreigners have been selling them, we've been buying them chasing yield. So if you really want to get into the weeds and talk about resetting the system, we're resetting predominantly upon the American people. Only about 7 trillion is owed. That's a lot to the rest of the world, but to the American people, it's the majority. And what I was looking for earlier, by the way, Bank of America survey showed that 71% of financial advisors had a 0 to 1% allocation to gold. This was at the end of 2023. While only 27% had a 1 to 5% exposure, shockingly, just 2% of advisors reported a 5 to 10% allocation. And, we're nowhere near the top in this bull market, as the American participation in the face of, positive real yields, if you believe the BLS and the BLS and the CPI, positive real yield, strong dollar, no American participation, nothing in terms of institutional money, and it still goes higher. And that's because of the central banks. They're the most well-informed traders in the world, and Wall Street will catch on.
The 2008 financial crisis exposed numerous flaws in America's financial system, such as the inherent danger of America's largest banks being overleveraged. Seasoned analyst AndySchectman explained that tightening liquidity is causing banks to hesitate in lending due to fears of insolvency. He warned that resetting commercial real estate loans in a slowing economy could lead to a rapid credit strain, especially with the Bank Term Funding Program expiring on November 6th. The Federal Reserve's emergency BTFP dropped by $7 billion this week, with only $59 billion remaining. In 5 weeks, BTFP will be zero, pulling all remaining emergency liquidity away from struggling banks. Thus, the Federal Reserve's rug pull on the financial system was completed. A recent article in Cryptopolitan magazine revealed that American banks' potential loss exposure to real estate-related securities skyrocketed to $750 billion in the third quarter of 2024. Due to concerns about liquidity and credit crises, Andy highlighted the risk of significant deposit shifts to larger banks. It was suggested that the Fed might need to implement quantitative easing again, potentially intensifying inflationary pressures already reflected in the bond market and gold prices. Let's get back to the interview.
You're going to have, as these commercial loans and leases reset in a slowing economy with higher interest rates, a strain on credit, it can lead to a cascade very quickly. And then you end up with what happened during the pandemic, where these banks, or the banking crisis rather, where the banks they needed cash, and so they had to sell assets quickly. Those were the treasuries that led to a collapse in the banks, that all of these assets were underwater. They had to be sold at distressed prices. And this is a very bad thing. That's when the Federal Reserve came in and injected liquidity to keep the banks from collapsing, these emergency loans like the BTFP, which we've talked about. And ironically, the BTFP expires November 6th, the day after the election. And I think when that happens, adding more fuel to a fire, we can expect to see a tightening of liquidity, of course, for the banks that have been depending on it. And particularly, this really affects the small banks, the regional banks. The regional banks are the ones that hold 70% of the commercial real estate loans. They're the ones that hold 70% of the small business loans. They're the ones that are getting clobbered. Either the question then becomes, if the BTFP ends, is the Fed going to step in again when we see a strain in the banking system? And I think that's really the $6 million question. You could see a massive exodus, if you will, of deposits moving to the perceived safety of the larger banks. I think you could see what happened in Lindsay, Oklahoma a week ago happen in spades. And I think that that's something people should really be watching as the liquidity really is being sucked out of the system. And with the ending of this loan program on the 6th, it's only going to add fuel to that fire. So we have not experienced the end of the banking problems, and this liquidity problem is really this credit issue. It's real and it's not going away, and especially to a over leveraged, undercapitalized banking system that is about to really experience problems when all of these loans and leases and in particular commercial real estate loans start to and continue to reset over the next several months. Without that injection of cash that the Fed has been doing, I guess we'll have to go back to quantitative easing again, and that just exacerbates the sell-off of the back end of the bond market. You're trapped. In other words, either you let the economy sink into a depression, or you continue to do what everyone has done prior, and that is to inflate the heck out of the currency, which the bond market will sniff out and which gold already is sniffing out. And I think that's why you're seeing these things happen concurrently.
The Fed loves to dress up its moves in economic stability language, but anyone watching closely can see what's really happening. However, the BTFP's favoritism toward larger banks jeopardizes competition and accessibility for smaller institutions. How will the continued rise in gold prices and the potential instability in the banking system influence investor sentiment and strategies moving forward? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.